Powell's comments out of Jackson Hole were great clarity from a man who does not usually give us such clear ideas of what's to come with Fed policy. So yes, I believe a 25 basis cut is all but cemented for September. I do think it's a bit premature. I think the market is looking for a little bit more with that 50 basis point cut. I personally do not believe that would be on the table for September. But Powell did give us some sign that this will not be the only cut, right? He alluded to rate cuts, plural, and talking about the pace and the magnitude of those going forward. So this will be the beginning of a rate cutting cycle. How long that lasts, though, I do expect to see inflation rearing its head again in 2025. So I think a lot of market participants are going to be disappointed by this cutting cycle.
Okay, so unpack that for me, because I thought your comments on the inflation outlook are particularly interesting here. You say the fundamental drivers of the next inflationary cycle are already firmly in place, and inflation is going to come back in 2025 and limit the Fed's ability to continue cutting rates. So what is the primary driver of that inflation reaction in your view?
Sure. If we look at some of those fundamental leading indicators, again, things that don't affect inflation today, but a year or two down the road, things like the velocity of money, things like gross treasury issuance. We actually see gross treasury issuance today in the United States at a higher level than it was at the peak of our pandemic stimulus spending. So there are a lot of drivers starting to align. The stars are aligning for inflation to come back again in 2025. I think we'll touch that 2% target rate, but I don't expect we'll stay there very long. The Fed does have their work cut out for them in the years to come.
So wouldn't that justify a 50 basis point move now? That's the argument that some economists have been making here, saying the Fed needs to cut hard and fast in order to tame what might be higher inflation to come. Could now be the right time?
Given how they got burned with high inflation and waiting too long, even in Jackson Hole, Chair Powell made comments about how many economists, and he grouped everyone in there, expected this pandemic era inflation to be transitory. That didn't really play out. So while their focus has clearly shifted to the labor market side of their dual mandate, they don't want to let inflation out of their sight. So cutting too hard, too quickly, that could bring activity back in a way that stimulates that next round of inflation, that keeps us from reaching that 2% goal. So they are very sensitive to not letting inflation get away from them again, as we've seen in the past couple of years.
And Lauren, walk us through what we can expect to see from markets as this easing cycle begins to be priced within equities and risk assets broadly.
Sure. I believe last I looked, there were three 25 basis point cuts fully priced in for this year. I think we might get another one in early 2025. But again, beyond that, it will just depend how the data comes in. So I think the market is looking for a little bit more than the Fed is likely to give us. Again, the Fed likes to wait, likes to be a little bit more cautious. They do not knee-jerk react to data coming out, as we saw in August very clearly. So I think the market is looking, reaching, aspiring for a little bit more than we will ultimately get. But at the end of the day, the beginning of the rate cutting cycle, that is likely to be good for a lot of asset prices.